Yeah, absolutely. But let's welcome on board Geoff Dennis as well and figure out what he's making of the market texture right now and how is it that we should be trading in this, or rather investing in this very uncertain world. Geoff, great to have you today on ET Now. Thank you so much for your time. Geoff, once again, the US-Iran ceasefires collapse. You are seeing that impact rub off on oil prices as well. Brent back at 91. But again, it's not like it's a line in sand, so to speak. How do you think investors should be treating the latest developments from West Asia?
Well, I think that what you're seeing here is just continued volatility in the oil price. And of course, right now it's going up again because there's more uncertainty about whether there will ever be a proper ceasefire or we'll ever get the Strait of Hormuz open again. So oil prices are a real factor that is worrying investors once again. But as you mentioned on the program a couple of minutes ago, the other thing that's really bothering people is the rise in bond yields. And this is because of a couple of things. It's not really the recent inflation story, although, of course, Brent will play into that inflation story as we go into the next couple of months. But there's also a lot of concern, I think, about a lot of doubt, let's put it this way, about the new Fed chairman, Kevin Warsh, and what's actually going to go on here. A very difficult, uncertain first press conference, and we just don't know what the Fed wants to do, what they're thinking. We're short of information. So I think all of these are pressures, while at the same time, earnings are good. I think the US economy is okay, despite the some soft data recently. So I'm not negative on the market per se, but that's what people are watching. There's a sniff of stagflation at the moment.
Okay, Geoff, therefore, how should one play asset classes? Do you believe that US looks better? Do you believe that there could be a tactical trade in some select emerging markets? Would India feature at all?
I don't think India is going to feature greatly at the moment because, as far as I can see, India's concerns about India are pretty much what they've been all year. We've had a weak rupee, although, of course, it's stabilized a little bit recently. Real interest rates are now much tighter because we're still at 525 for interest rates. Inflation's picked up a little bit. The real story, I think, in emerging markets today is, although we still have got about a 900 basis point lead over developed markets, that's narrowed considerably. EM is about 6% off its high in late June, and that's primarily because of this major sell-off in Korea, where the AI stocks and the perhaps I should call them the technology stocks really have done, which did so well earlier in the year, have pulled back dramatically and have not rebounded. Whereas a lot of those stocks in these, not all of them, but a lot of those stocks in the US have started to rebound. And what that's giving you is new all-time highs in the S&P. So the performance gap between the US and EM is narrowed. I still like the look of EM because the dollar, I don't think looks particularly strong here, although it has been strong lately. And I think the investors will still take a look at Taiwan. If they want to be brave, they'll look at Korea, and possibly for more defensive purposes, if we can say that, possibly in India as well. At the same time, look at Latin America. Brazil and Mexico pull back a lot. So this is really now in EM this year. This is just Korea and Taiwan. That's what's leading the way, and everything else has been somewhat disappointing.
Right. But Geoff, do you think the AI trade will still hold?
I do, because I think that although there is inevitable concern about valuations and the amount of capital spending that these companies are doing, especially what we now have to call the hyperscalers, at the end of the day, earnings growth has been stellar. And therefore, I don't think the valuations are quite as much out of line as you might think. So I don't think, I've said this all year, I think it's going to be volatile. I don't see, though, a major medium-term sell-off in the US market, which will pull these AI stocks down, for the sake of argument, 30, 40%. I think the market looks reasonably well based, unless that is we get a further pickup in inflation, which the Fed does not respond to. My own gut feel is the Fed possibly raises rates in September. I know that's not the consensus, because at the end of the day, oil is going to push inflation up. And I think if the Fed does that, that'll help the bond market, and that, oddly enough, will probably help the stock market as well, because confidence in the Fed right now is quite low. But if you roll all this together, the growth in earnings that the AI and the general technology stocks are getting, not all of them, but a lot of them, I think will be enough to keep this trade going, even if it's not going to go up dramatically from here. I just don't see a major sell-off. That's my point.
Point taken. Geoff, how do you look at some of the alternative assets like gold? What do you make of the US 10-year bond yield move? Is it a good time to probably park money in either or both of those?
Well, it's very strange because gold is behaving differently to the way it normally does. Gold was very strong earlier in the year when the stock markets were roaring, obviously AI trade especially, and certain emerging markets, and now it's pulled back a bit. And actually, it doesn't seem to be reacting the usual way, which is that when inflation goes up, gold as well. So gold is a bit of a mystery to me, and I've never been a big fan of investing in gold, frankly. I am concerned, though, and I think this is the biggest risk to equities going forward. I remain very concerned about the bond market here because I think there's more inflation in the pipeline, despite a couple of decent numbers recently. And if that were to happen, there'll be concerns about the Fed with this kind of mysterious new lack of communication approach of Kevin Walsh. I think there's a danger that investors will lose a bit of confidence here if inflation picks up, unless the Fed starts to move to higher rates quite decisively. So I'm wary about bonds. And of course, as ever, in the US and in a lot of other countries, particularly in the developed world, you've got enormous fiscal deficits. So I think bond markets, which traditionally do well when equities go down, it's not much of a safe haven right now. And I think the danger is we're going higher in terms of yields, not massively, but I think the risk of stagflation here, doubts about the Fed, pickup in inflation mean that probably 10-year yields are eventually going to push up towards 6%.
Right. Okay. Geoff, great to have you today on the show. Thank you so much for your time.